afternoon, or evening, wherever you're catching us from. We're here today to, as we say all the time, let's talk real estate. So here I am, Glenda Kroll, with my greatest sidekick, the lion of real estate, Mr. Ari. Can you
Hello.
give a good morning to everybody?
Good morning. Good morning. Hope everybody's doing good.
So it's an incredible, wonderful day today. We are having some incredible weather in the Toronto area where we're
No, I'm
speaking.
wearing a t-shirt.
Crazy. I've just spent the last 4 days up north and had incredible, beautiful weather. It's not usually like this at the end of October, but I'm grateful for everything. So today we're coming to you with a very special show. We have an actual professional on the line that's going to help people to key in and learn the terms, learn what they need to know. It's all about mortgages. So, even though Ari is a professional in this, but he turns to somebody else to go when he's going mortgage shopping. And so he is not the one that who actually gets you the mortgage, although he works with somebody, and we'll explain more into this. So today we're going to bring upon the dream key of mortgages, Mr. Mark Barykin. And he says, after his tenure of working with some of Canada's largest financial institutions, he learned the importance of exceptional customer service. And he fell in love with helping others exceed their financial goals, ensuring that he would always stay knowledgeable on the ever-changing rates, mortgage rules he adopted of let's get it done attitude. I love that. And for there, he pursued the fight for his clients for the best benefits, amalgamations in their debts under a single lending facility, and any way he can help them grow. It's a truly amazing what you can do, he says, with a small amount of money put away each month. And I believe in all that. So let's bring him on, Mr. Mark Barykin, and welcome to Let's Talk Real Estate. How
Thank
are
you
you?
for having me, Glenda and Ari. Hi,
Hey,
everybody.
Mark.
How's it going?
Well, we are doing phenomenal. We are at the beginning of our stages of growing our, which is right now Facebook Live, but in turns, we will turn this also, for those wondering, into a podcast. So we need to start talking because we're here so that we can educate people. It's before you go shopping. I believe that the important part is to understand things. Then just you can't just go shopping if you don't know what you're buying.
Absolutely. That's the key right now, especially with the interest rates going up pretty much every month. It's getting more and more expensive to have a roof over your head and to buy something, which is a Canadian dream, right?
Yeah.
At the end of the day, to begin your search, you got to first set your budget. Sometimes it's not about what you can afford or what you can buy. It's about what you can afford and still not be a house poor, right? With that being said, you set yourself with a certain budget. Let's say nowadays, it went from 2,000 to like $3,500 a month on your shelter cost, kind of thing. And of course, the best way to go about it is, in my perspective, is the short-term mortgage for now, right? So if you take a fixed short-term loan, let's say 1 or 2 years, to ride out the recession that's coming our way, as well as all these interest rate hikes, and wait until the interest rate stabilizes, which has been around 3% for the last uh, decade, over a decade. As long as I've been working as a mortgage agent, I've always seen the 2.99s, the 3.5s, went as low as 1.6% about a year ago in the summer. However, now a 5-year mortgage is selling for at least 5.2%. That's pretty much the minimum benchmark right there.
So before we jump into this factor, because there's a lot of people who at this point in time don't know even how do they prepare. Let's say that. how do they prepare for a mortgage if they're looking that they want to even look at buying mortgage? But we start with, like you say, of knowing what they can afford.
Right. So
Before
knowing what you can
somebody's
afford is
coming
the
to you
number
with the
one thing,
first,
right?
sorry, go ahead.
Knowing what you can afford is number one thing. And second of all, you always need a down payment. Before, I think 2 years ago, there was a change where CMHC, Canadian Mortgage Housing Corporation, had a product where you could actually borrow the down payment from a line of credit or a credit facility. However, that has been annulled and the program is not available anymore. So the down payment is the key aspect. Without having a down payment, which is minimum 5% for the first 500, then 10% going forward. So, example of $700,000 loan, your minimum down payment would be $45,000. Without having a minimum down payment, you cannot make a purchase. So, the to start off, you need to save. You need to put away money. You need to get in a position where you're able to stack some cash away into a savings or some sort of investment vehicle that will help you, grow over time and combat the current inflation, right?
So when you put up a minimum, so if somebody, let's say, has $100,000,
Right.
at that point in time, like you said, there's a whole stream of how much you can put down, 5, 10, or 20%. And I know when we're talking about a home where somebody is living in, what is the minimum and why do we want to go a little bit more than just the minimum?
So minimum down payment, as I just mentioned, for a primary residence is 5% for first $500,000 of purchase, right? Anything above 500, you have to put 10%.
Okay.
So it averages out, let's say, about 6.7, and it goes up and up and up from there, right? Up to $1 million. $999,999 will be your cutoff for this specific program for now. Changes are being discussed to increase that because GTA and Vancouver areas, you can't really buy much for $1 million when it comes down to a house, right? So it's like that program is not available for people that are trying to buy a freehold home or semi-detached or any of those kind of properties. So CMHC, Canadian Mortgage Housing Corporation, is trying to make some changes to make availability for those clients that have substantial income to be able to afford something like this, to be able to buy with less than 20% down. Now, why would you want to use this program? Well, obviously, you want to get your feet into the market as soon as you can. The earlier you buy, tends to have the greatest outcome, right? In
Right.
in terms of equity growth. However, nowadays with the declining prices is a little bit different. I would still say to anyone that now is time to buy, because at the end of the day, in Canada, supply is the issue. Supply and demand, they coincide together, and when it comes down to excuse me, it's my puppy. And when it comes down to
Love puppies. It's okay.
uh, so when it comes down now it comes down to, are you able to buy or not? Now, before I ramble off topic here, I just wanted to say that there's for buying with a minimum down payment, you do have an insurance premium which ranges from 4 to 2.8% of the mortgage amount. So it's obviously like tens of thousands of dollars. To avoid that, you would have to put 20% down and make the mortgage conventional, which comes with a whole bunch of other perks as well.
Okay, so when you are now seeing a client coming to you, or maybe just a potential client, what is the checklist of things that you're telling them they're looking to? They want to get into the market. They have a bit of money to put down. They haven't maybe found the property yet, but they're just trying to find out what they can afford.
So first thing is to put the application together, and I'll send you guys a link later on to see what the application looks like. It's basically a web page, it's a secure web page that will gather all your information and populate it directly into my system, which gives me ability to have credit consent. Whenever anybody's pulling a credit bureau, this always has to be a credit consent, so they just can't pull it and have a look at it. For me, that's very important because part of compliance. So once I pull the credit bureau, I put the application together. What I then do is I ask them for their income paperwork to make sure that the income stated in the application, is cross-referenced and is correct, which in a lot of cases can be a little bit off, right? And then the pre-approval is pretty much live, right? So then it's all about sitting down with the client, going over the details, making sure that the application is 100% correct. What I do then and say, okay, well, what area are you looking in, right? Let's have a look. Let's pull up realtor.ca and let's just see examples of properties, so I can use the parameters of where it is, as well as what the taxes are going to be over there, right? As
Right.
well as land transfer tax. So in land transfer tax in Toronto is double
Right.
than anywhere else. So you got a budget for that as well.
Mark, I just want to jump in. Okay, so I have a couple of things I want to say. I was waiting for you to get to this part. So first of all, this is where there's a huge difference in applications, mortgage brokers. Okay, I know this even firsthand. Okay, so I'm gonna go back for a sec. You said something about pulling a credit report, right?
Right.
You wouldn't believe how many clients come to me and they told me, I'm approved. I got pre-approval. I got the numbers. I know my max limit. And I mean, not to say that they're lying, but I used to fall for that when I started in real estate, because if somebody says this is what I'm approved for, you automatically assume they're approved. Then the next question is, have you obviously talked to your mortgage broker? Yes. So how can you doubt that, right?
Yeah.
What I learned is it's just like in real estate, and I believe in any business, like even like, I guess, lawyers, right? Like there's a huge difference when you're dealing with people. And in your business, correct me if I'm wrong, but I've noticed that there's a lot of mortgage brokers that would just give a number. They would ask a bunch of questions. And like, for example, I call a mortgage broker and I start asking questions like, hey, this is how much I make, this is my debts, this is what I want to buy, I don't know, a whole bunch of stuff. I basically do an application over the phone, and then they say, you know what, you're approved for say 900,000. The problem with that is that they didn't pull a credit report, they didn't ask you for the documents, so you didn't send anything in. Even if you did, sometimes they don't actually look at the details. Like the fact that you just said that you go as far as looking for the property tax in the area they want to buy. They don't know this. They don't know that the property tax can lower their mortgage approval. They don't know that maintenance on a condo can lower their mortgage approval. Like I have people that come to me and say, I'm approved for $800,000. And the first question is like, did your mortgage broker take into consideration a maintenance fee? Because if there's a $400 or $500 maintenance fee, you're not approved for 800,000 if they actually did it on a freehold, right? So there's so many little variables, and one of the things I like to tell my clients is you need to make sure that it wasn't just an application that they took from you. It was properly, just as if, like you said, I don't know if what go live means, but like actually get all the paperwork and properly structure it as if like you were making a cash offer, no conditions. You need to make sure that the person you're working with, before you even go shopping, checks everything out. Again, I've had clients come back and say a week before closing, my mortgage broker didn't realize that that I had another debt of like $30,000, or there was a furnace owing or whatever, right? And then all of a sudden, your mortgage falls apart. there were a couple of days ago, and this is the last thing, I don't want to ramble, but I saw an article about this family. I'm not going to mention the bank's name, but it was a family that basically were all they were doing is porting their mortgage. So they were basically selling their house, and they were buying another house. So they bought another house, and they wanted to get like their current mortgage moved to the new house. Right.
Yeah.
We talked about porting on the last show. So everything was done. They kept on going back to the mortgage broker. The mortgage broker said everything was good. They even went firm on the new house. They sent the mortgage broker the deal with the MLS and everything. And mortgage broker said, good, you're good to go. A week before closing, the mortgage broker says, I made a mistake. They looked at the MLS, and they didn't realize that the type of property that it was it wasn't like a regular residential property, right? But they had the MLS all along, right? But they just said they made a mistake, right? They gave him, I think it was free banking for a year, but that family had to basically cough up all the money that they were going to put aside by selling and buying to a smaller home. And they got into a situation where they didn't even have money for furniture, right?
Mm.
Because instead of having a little chunk of change, which they were going to put aside,
Right.
they ended up losing all that. And the funny thing is, when I looked at the comments of this article, it happens all the time, right? So I can't stress how important it is to make sure that the person you're dealing with is really breaking everything down, making sure that you didn't miss anything. But you didn't miss anything, not just them, that you submitted all the information. They need to look at your credit report line by line, make sure that they see all your outstanding debts.
And that was the other thing I wanted to ask. What happens if you have something that's registered on your name and it's not from you? Do you work with people to get things off of their credit report that maybe, somebody else has registered a debt which isn't theirs, or something else has been on? And I know that happens many a times.
Yeah. I actually do have my brokerage has their own Equifax code number, so I can do a few things in the credit report that are within my limits, right? For example, if you pull extra credit bureau, or there was no consent given on one of the requests, you can do that, as well as if there is information that you can provide me. For example, I paid out or a cleared or letter of clearance from a collections agency, or let's say a letter from Rogers saying that they have made a mistake. I can always try it and rectify it with them, but unfortunately, that's not like really the big scope of my work, right? So in some cases, I've done it before, but it's gotten harder and harder to actually get that done. Most the best way to go about this is actually guide the client what to do, right? So guide them to what to say and how to position your situation to Equifax and deal with them directly.
Fair enough.
But
I just want to add one more thing to that. So if sometimes Equifax, and I have experience with this stuff, so if sometimes Equifax will and a lot of times they'll tell you to just go directly to that creditor, right? So if you see something on your credit report, say, okay, this is not fraud, obviously. If it's fraud, then yes, Equifax will deal with it. You have to obviously submit a fraud report or claim, right? But if there was something that you, for example, find that you paid, but they still have it registered as unpaid, or it's like in collections, what Equifax sometimes will tell you is to go directly to that creditor, and that creditor needs to update that. Now, the other thing I want to mention too is it's very important. They'll say they'll do it, and they will do it, but make sure you ask for a release letter, because that release letter will actually be used. So if you ever, it could take them a month or 3 months to update. But if you have that letter, you can give it to Mark, and Mark can basically work with that letter.
Absolutely correct. That's the letter I mentioned just a little bit earlier. The release letter or letter from the bank just saying that they've made a mistake, right? Lenders will work with that. In the meantime,
does the bank ever say they make a mistake?
Yeah, they do.
They'll give you free banking for a year.
Not only that, but a lot of the banking is ran by people too. So you got to remember that. It's like you and I. It doesn't matter how old or how long you've been, doing this for. You're human. So there's a margin for human error. You will make a mistake, right? Otherwise, you're like some sort of a robot. And even for robots, as soon as you give them something that is outside of their normal scope of work, they will also make a mistake. Like your computer or something, right? So think about that. Anyway, so a lot of times that I've seen these deals fall apart is because of the negligence to go over the details or simply inexperience. So that's why it's very important for you to, as a client, for you to partner yourself with somebody that has that trust, has the Google reviews from many people that you can cross-reference, that they've been around for a while, right? If you look up a mortgage broker and you realize that they've been in the business for 2 years, I would be a little skeptical to essentially work with them because because I like to have experience under the belt kind of thing. But also branches, you got to remember that if you ever go to a branch representative at a local whatever bank, right? I'm not going to mention any, but a lot of them actually work on many different kinds of tasks and chores within the bank. So opening up a credit account, opening up a checking, savings. So the amount of information that they need to know is really, really big. So they don't focus just on the mortgages. They do everything, right? That they do everything okay or well.
And they
But
leave at 5 o'clock.
sorry?
And they leave at 5 o'clock.
They leave at 5 o'clock and they don't work Saturdays and Sundays. And I try not to work Saturdays and Sundays as well, but when duty calls, I always pick up the phone.
Of course.
Now, you are at more of a risk to go and have something go wrong with a person like that because they forget about deals, they neglect, and sometimes they don't know what to ask for, and the underwriter will come back and say, I need A, B, and C and D, but they don't even know where to go to get it. They will go ask their branch manager, and branch manager is a manager. They were in the same position as them before. They never did mortgages full time. So simple things like taking something off title, or looking at the credit bureau and getting a letter to combat the problem, right? So if you don't know if you don't have experience, you haven't seen it before, you might run into a problem and you might turn a client away, especially on pre-approvals. You wouldn't believe how many people has come to me and said, oh, I know, I've been to so-and-so bank, but they told me I can only afford $200,000. What you can buy for $200,000 in Toronto or in GTA general, maybe a shed and in a store like that.
Let me interrupt for a moment. You talk first of all about pre-approvals.
Right.
So can you explain to people why they need a pre-approval, or if they do need,
or what's the difference?
or what is it? Right.
So pre-approval is generally a rate hold, right? So pre-approval, when you go to a bank and you say a pre-approval, it's 120-day rate guarantee that if you buy a house and you move in there within 120 days, you will get that specific secured rate. As a mortgage broker, you have to go above and beyond and pre-qualify the client on your own, right? So the pre-approval is a piece of paper that basically says your rate is good to go. it says we're going to still ask you for all these documents when you find a home, because for them to underwrite and to give you a financial approval, they need to hire 300 more people to just, service Ontario. They don't have the manpower or the ability to help somebody with a pre-approval to a point where it's completely written up. That's up to a mortgage broker. That's why I ask for the documentation up front. That's why I ask for to see what the properties are of interest. That's why I like to bring people into my office, which is on Jane and Dundas in Toronto, uh, and sit down and break everything down so everybody's on the same page. There's no surprises whatsoever.
So you recommend somebody come in and for pre-approval. And for people that don't understand, why do you do this?
You do this to make sure that when you go and put an offer, and we go through with the mortgage, you go to an underwriter, they start looking at the documents, and they start engaging in process, whatever it could be the insurer or their internal, approval department. We're gonna actually get an approval, so nobody's wasting their time. Like myself, I'm not wasting my time doing all this, or Ari is not wasting time going around town showing all kinds of condos and houses to this client, right? So at the end of the day, that's what makes a successful mortgage broker: the proper pre-qualification. And at this time, the rate holds are very, very important, right?
Well,
Because
because right now we're dealing with the rates that are now starting to go up.
that's right.
So, okay, so somebody now has a pre-approval, and that means that they have they have the ability to know what they can afford, correct? With this
Yeah.
pre-approval, it gives them, it's kind of that security on that paper that now they have an idea of what mortgage rate they will get.
Yes.
How about, I'm sure in every mortgage there's all different terms that can be in mortgages or cannot be in mortgages. Like, are all mortgages created equal? Do they all have that ability to be portable?
So let's begin with understanding what the tiers are of the mortgage. So there's three major tiers of the mortgage. You got your standard banks, which is A banks: Scotia, TD, Bank of Montreal, CIBC, HSBC, Meridian, Duca. Those two are credit unions. However, they do land in the A space, and the A space is for people that are with 5% down, right? Minimum down payments. That have to be insured, so everything is income qualified. You 100% have to make sure do the pre-approval, pre-qualification to make sure that they will get approved. Now there's also a B lending space. So a lot of the A lenders that go with the, let's say, perfect kind of client, perfect case scenarios, they also do B lending. B lending is a little bit more they just need different documentation per se. It's definitely more expensive. The biggest thing is that for B lending, you have to have 20% down.
Okay.
So that's the minimum threshold for B lending. They also allow B lenders will allow you to have longer amortization, for example, 30 or 40 years, 30, 35, and 40 years. They also work well with business owners. A lot of business owners don't claim all the income, which is fine. You have lots of write-offs, but you're writing off things like a car, you're writing off things like meal expenses, so on and so forth, to bring your income down. The B lender will actually take an average of 6 months, and then they will qualify you based on the average for so you could be 1 year in business.
Okay, so the pros and the cons between going from an A lender to a B lender?
So I put it this way. So I'm like, you're a business owner, right? You're working and you make $300,000. Well, on $300,000, your income tax is close to, let's say, 45, 30, 45 something percent. So it's quite a bit, right? That's 150,000, let's say. Let's make that calculation easy. 150,000 is how much of your income have to be given to CRA, purpose of income tax. Well, if you bring all your income down, now you have 100,000 that you're claiming in income, and on that money you only have to pay $30,000. So 150 and 30 is a big difference,
Right.
right? That's a Tesla right there for you. However, B lender is more expensive. So first of all, they will ask. So they're about half to a percent higher than the A lender, right? Then they will ask a fee up front, and the mortgage broker will ask a fee up front before the mortgage closes. So, or at the closing time. So even with those fees and a high interest rate, if you look at the savings that you're saving from not paying as much income tax and writing everything off, it's well worth it. The only stipulation is 20% down. You always have to have 20% down. As of a couple years ago, actually, there's been some really good changes to CMHC self-employed program. So there's a stated income and the new self-employed programs now, where you can put as low as 10% down using your, I just had the deal actually, bank statements and some other documentation to qualify for a mortgage. So it is still possible. I will always look for the cheapest route for all of my clients first, no matter how hard it is to get done. But the worst case scenario is the B lender. It's always there. Now let's talk about private lending. So private lending is for those people that have, either bad credit but lots of money, which is a lot of contractors have that, which need short-term financing. Some, house flippers, right? Or buying such a, expensive property with smaller down payment, but able to afford it. Obviously, you don't want to lose your house. That banks don't usually land on. So there's in A landing, let's say Scotia, CIBC, TD, as well as B lending, Home Trust, and etc. IC Savings. There's always tiers of lending. So let's say if you buy a $3 million house, you will get 80% of 1.5 million or 2 million, and then it goes to 60% of the remainder. So it's always a tiered program. And sometimes, let's say you're buying $5 million house, you don't have 1.75 million to put down as a down payment in cash, right? So you want to put 1 million down. You use 750 to upgrade your house, and maybe then flip it for $6 million. That's a private lending situation for you, where a private lender will take 80%, of the purchase price as the minimum down payment.
Okay, so I'm going to mute for a minute, and Ari's going to be asking you some questions because in my condo they're doing fire testing.
That's great.
Oh, that's what it was.
Well, you never know. When you're live. So it is what it is. So let's
Mark,
continue on.
sorry, go ahead.
Wow.
Oh, I was going to say, so we've touched on a couple of other things in the past. It was about owning investment properties.
Right.
Okay. Maybe touch on, is there a difference in terms of getting just a mortgage for your principal property? What do you have to do, or how do you qualify for secondary property? Is there advantages if you have a tenant in there, and so on? Also, maybe even touch on duplexes, because I have clients that always ask me about them.
Right. So when it comes down to investment properties or any kind of properties, it's the way to build wealth. Let's not kid ourselves. The old put away money into your RSP kind of thing has failed our elderly. And from what I'm seeing now going forward is that a lot of people are used, especially the older generation, with improper. I mean, at the time it seemed like proper, but with the inflation, rising costs, and 21st century, all the gadgets and widgets and new fridge and whatnot,
I'm going to stop you for a quick second because I want to just actually make an example. I was reading a book. Um, you might think it's funny. It's a book about, anyways, like different philosophies and stuff like that. And it's really old. Like the person who wrote it, I think it was like 1900s. But the funny thing is, they were talking about how $50 a month was what people were making as a normal salary. So when you say that, when the reason that I guess like the retirement pension fund and all that, it fails us is because, like think about how quickly money value, inflation like we're dealing with now, goes up. So if in the 1900s, I know it's a long time ago, but like if $50 was what you were getting paid a month, what's $50 today? Then think about your childhood. Like I'm 44 years old, and I remember when I was younger, McDonald's Big Mac combo supersized was like $5. Not even, didn't even break $5. I think today it's like 8 or 9. I don't know. I haven't had one in a while, but like that's what I'm saying. So if you put your money away, I'm not saying it's the wrong thing either. You should probably talk to your financial advisor about that. But from a real estate perspective, I believe that, you know, um, inflation and putting money away, it almost like it doesn't work for you because you're putting away, say, $100,000. What's that 100,000 going to be worth in 10, 20 years? Right? Like obviously you see yourself today, expenses are basically through the roof. Like food costs more, material costs more, everything costs more. So you need more money. So if that money is sitting in an account, it's being devaluated as time goes by.
Correct. So, um, a lot of
Didn't mean to throw you off track. Sorry.
90. So back to my point there. Uh, I think like 95% of world's millionaires and billionaires gotten rich through real estate. So my point is that investing in real estate is your best and ultimate retirement vehicle because you have people just paying your rent, paying your mortgage cost for you. Your liabilities are decreased, and at the end of the day, it's all about affordability, right? Let's say, for example, I live in a duplex. I needed a duplex myself, right? I bought a home, I made a duplex. It's all about the bringing down the cost of your shelter, which is ultimately high. With having a basement apartment, that supplements your income and helps you essentially have more income to do other things with, right? Um, Now, what do I think about investment properties? I think that is absolutely the best way. Should buy them, you should hold them, you should carry them as long as you can, or until time comes. Sometimes it's just a time to get rid of it and get another property. That's just the way it is. You always have to look as an investor, and say, hey, look, is my property in Hamilton gonna go up anymore, or has it hit the peak, right? If it hits the peak, then just get rid of it. Don't think about it. Get something else. Get something bigger and better, and more suitable for as a lengthy investment vehicle for your money. Now, buying an investment property is hard because you have to qualify for 2 mortgages, but that's where you engage a professional like myself, and I do pre-qualification. I can tell you how hard it is or how easy it is. Some people think it's harder than it actually is. In most cases, most banks, they will charge a little premium on how much on the interest that they will give you, right? Because technically it's not a primary residence, it's an investment. So before 2018, it was just a mortgage across all aspects of the field, so to speak. But with 2018 changes, they changed that, and they made some things like rental mortgages for rental properties a little bit more expensive, because what it is it's an investment. So why not get a commercial mortgage, which is 5, 6, 7%, right? You don't get a commercial mortgage because it's a residential property. You can't get a commercial mortgage on a residential property that is under 5 units, like a fourplex. But at the end of the day, is that when you're making money, everybody wants a piece of it too, right? So you have to pay income tax, the government, as well as your mortgage rates will be higher.
Mark, what do you think in terms of obviously we've had a bunch of rate increases. What do you think of this market? Where do you think it's going, and how long do you think it's going to last? I know it's hard to say. I know nobody has a crystal ball, but I figured you're right in the middle of this whole thing, so you might have an idea.
Uh, well, to be honest, it's gonna last as long as everybody keeps spending. That's how long it's gonna last. So if you keep buying you know, the whatever, like, small little widgets online that you don't need and wasting your money on, going out, it's just gonna drive our inflation rate higher and higher and higher, which has been stable. To be honest, actually been declining. So we're in a better position now than it predicted to be. But I foresee the interest rates going up probably one or two more times.
Okay.
And but the biggest thing, Ari, is like I believe that you always have to increase the rate and let the effects take it. They've been increasing the rate so fast.
Yeah.
This It's literally like a steep curve. If you look at this year and the rates have gone, they went from 2% back in January all the way to some mortgages are hitting 5.7, and it's
And
going to be 6% in a month.
and since you're on that topic, maybe you can touch on like what you think. Okay, so maybe first, I don't know if I think we did touch it, but like maybe you can touch on it again about the stress test, and what do you think about it? What do you think about like right now, say if somebody was to qualify for a mortgage, maybe explain how the stress test would affect them. But then also, I want to know from you, what do you think in terms of what to do right now? Fixed or variable? What would you recommend? I mean, I think they're meeting or they're going to be potentially increasing the rate again, right? So I just want to know if it keeps going up, would you recommend to lock it in at this rate, or do you find it at this point a little too high and it's not worth locking in?
Well, the strategy that I would say fits the best for this kind of environment is to take a short-term mortgage, right?
Okay.
But
Short
what
term, what do you mean by like a year?
A year would be ideal, I would
Okay.
say. Even if it's higher than a 2 year, at the end of the day, you don't want to pay a penalty, right? So the strategy is to get a 1 year mortgage. Then what you can do is you can pick a variable mortgage upon renewal. Variable mortgage is lockable, so you can turn that mortgage into a fixed mortgage with no penalties whatsoever. So you hold your rate for 1 year, so you don't go, so the variable doesn't go crazy on you. Then you lock yourself in within about a year into a variable, and you just watch it go down. As the fixed rates go down to a comfortable point, I would say 2.99, 2.89, anywhere around there, that's when you make the jump from a variable to a fixed and you carry on if you choose to stay there for the X amount of years. Excuse me for 1 second.
You gotta go deal with the dog.
So I'm going to hope that my sounds don't go flaring out. Okay, so let's explain that. If we get into a variable, and what happens if you have down the road, you click into a variable for a year, and what if interest rates continue to go skyrocketing? What are the options of a person?
Well, you can always lock yourself into a fix, but like I said, if you're getting a mortgage now, absolutely best strategy is to have the 1 year, 2 year fixed, right? In 2 years, we expect that the rates to start stabilizing, start going down. As we go into a recession, the first things that go down to make lending and more money accessible to people are the interest rates, right? So that's the first measure the government will take once it's announced that we are in a full swing of recession. So whatever that is in 6 months or 12 months, it's gonna happen, right? This is all temporary for the time being to combat the inflation and to help people. But the problem is that the rates are also causing inflation. If you think about the cost of living has gone, before, let's say in January till now, for example, my mortgage is up by $1,500 a month. So if that's not contribute, if my mortgage is, double, my interest portion of my mortgage is double of what it was before, obviously that's contributing to the inflation. And perhaps what they're doing is essentially creating that barrier that when they do drop the rates, the inflation will go right back to normal, 2%.
Okay, let's talk about, you said about when you buy a mortgage, it's amortized over a certain length. And you mentioned that, there's 30 years, there's 40 years and onward. Can you explain to people what that means by how it's amortized? And I know it sounds ridiculous to ask, but I was very surprised when I spoke to somebody recently about a mortgage and was talking about this, that how they assumed something was totally out of the ballpark. So there's obviously people there that don't understand why we amortize a mortgage over a 30-year term or more.
Right. So a mortgage is a large sum of money that you borrow from the bank. So they as in the bank, or ultimately, the lenders that you borrow from, they give you a time, right? So they give you time to pay off the loan, which is called amortization. Slowly it goes down. You can re-amortize your mortgage if you want to refinance, or when you move from one place to another, you can also re-amortize the mortgage so your payment is smaller. However, you do have to have some sort of a schedule on when the investors, the lenders, will get their money back, right? So the amortization, when it comes down to the minimum down payment, you're limited to 25 years, right? Which sounds like a long period of time. However, the amount of mortgages that have been paid out via natural discharge has been at all-time low in Canada, because people are realizing that you make more money by having the shorter, smallest payment, keeping more money in your pocket, and then your property growing like crazy over the years, right? Like, for example, the year over year, what was it, like 20% that we just had? A crazy increase. We're down by 20%, so it's been a bit of a roller coaster. But when you put down 20%, it's a little bit of a different scenario. So when you put down 20% on a normal conventional mortgage with an A lender, you can get up to 30-year amortization. The 5-year plus the fact that you don't pay the insurance premium creates a big difference in payment. The B lenders will offer you up to a 40-year amortization, depending on the lender. That's quite long, right? And so in some cases, it's worth it. However, private does not have amortization. You can set up an amortizing loan with them, but they do interest only most of the time. So that's even cheaper. The private interest rates are much higher than any others, in the margin of 200%. For example, if you're borrowing for 5% and an A lender, the private will be 10.
So what are the pros of going with the private?
Private mortgages, like I said earlier, is for people that have bad credit score, that don't pay attention, don't carry their debts. Maybe it's a debt load mismanagement, so to speak. As well as people who want to put down a minimum down payment on a really, really expensive property. They can afford the payments to do so, then go ahead. Or they want a short-term loan, right? So you pay the interest. So borrowing a private mortgage is like me borrowing from yourself or Ari, right? It's pretty much just any other person. Is not a bank. In some cases, it is a registered financial institution called a mortgage investment corporation. But in most cases, it's somebody that an investor that is looking to put their money somewhere secure, because you had a property secured on, as well as have a decent return.
So let's talk about when you build equity in a property and you want to buy a second property, and that property is an investment, and you take out some of that, whatever that property is now worth, that extra sum that that property has earned or over the time that you have it. Do you look at that in the mortgage, in the second mortgage that you're getting for your client?
Yes, of course. So you qualify to carry both mortgages, but you use your rental income or projected rental income as an offset to your income, to help you combat the fact that you have two mortgages. Does that make sense?
So if somebody now is looking that they want to go in and do something like that, do they have to go through any other, to go into investment purposes? Do they have to go through any other hoops that they necessarily wouldn't if they're buying for themselves privately?
Well, think about it. Everybody's financial situation is like a fingerprint. Everybody's unique. So best way to go about this is to give me a call. I'll work it out for you. I will guide you through the process. To understand how to invest into, specifically this market is very difficult, right? Because you have declining property values. So it's a lengthy topic to talk about. But why don't we talk about why the bubble is not bursting, Ari?
Why is it not bursting? Lack of inventory.
Lack of inventory.
That's honestly that's the only way I can explain it. I actually looked at. I was doing a letter of opinion for the bank, and there was a property that they asked me to appraise in April, and it was a different market in April than it is today because the rates went up and up and up. And long story short, I was actually surprised because when I pulled the all the statistics, the that specific area based on a detached same style home that I looked at in April was valued 100,000 less. But what was surprising was that the same the active inventory on the market was the same. So it's not like we have an abundance of properties on the market that are listed. It's not like there's so many sellers now that want to sell that there's like buyers can go and choose from all of it. It's exactly the same market. Nothing's really changed from what I saw. And again, it could be in that specific area, but I doubt that because I recently sold my own home and it was the same thing. There isn't an oversupply of inventory. It's just that what I'm seeing is that anything over a million or 1.1 million, there's a lot less buyers, if that makes sense. Less people are qualifying or less people can afford to buy those properties. So those sellers, which were the same, let's say, amount of sellers back in April, are competing for less buyers, if that makes sense. Where, I still think that in the long run, like, once everything does kind of stabilize, inflation gets controlled, and the rates go down to whatever they go, which, I agree with you. Like, I remember I was paying, I think, 3.5% or 4%. Before I renewed, sorry, in like 4 or 5 years ago. And that was the normal amount, like 3.5%. Today, I actually locked it in at 1.99 at the beginning of this year, which was great. But my point is that once everything stabilizes, once the rate goes back to normal, even at 3 or 4%, I still believe that there'll be bidding wars, right? I still think that there'll be, a lack of inventory, and I still think, like, I'll obviously, like, we'll see, but I think there'll be a lot more buyers back in the market, especially at that 1 million, $1.2 million range. I don't know about the higher. Like, again, there's just so many variables, but definitely, once it stabilizes, and I'm talking about the interest rates, it's gonna go back to appreciating again. Properties will start going up again. There's no doubt in my mind, and especially because, like, I think we talked about this in our last session. Even construction is halted. Like, a lot of builders are not continuing right now. They're waiting, right? And that means that we're not going to see any issues with it today, but we'll see the effect of that in about 2-3 years, right? When everything goes back to normal, and there'll be a huge demand again. And one more thing, again, I always kind of like, these are the three big factors. Immigration, right? Every year, I think they're letting in 350,000 people. So everyone needs a place to live, and rent's going through the roof, right? Which is good. Is what you said, for investment purposes. If you own a property and you rent it out, it's just going to keep going up. It's a cash cow, right? So, yeah, that's my answer.
So that number is actually over 400,000 new immigrants coming to Canada. And from my experience, they're coming here ready to start a new life. Half of them are, qualifying based on a points program. Either they're well educated or well rounded, or have equity that they bring in with them. But they're not just coming here to work in Tim Hortons, right? They're coming here. Most of them are being relocated because they're part of gigantic or worldwide organization, tech field, right? And because tech field is booming in Toronto, and they're coming here to buy a home, right? So they're coming here, and I feel like right now there's a lot of people waiting on sidelines. They're just waiting to see what's going to happen next year. And as soon as they stop raising interest rates, it's going to be like, so no better time than now to buy. If you wait, you can just be waiting for the rest of your life to buy something, because it just won't be affordable once again. My whole philosophy is that as soon as you're able to buy something, you got to just pull the trigger and deal with consequences later, because at the end of the day in Canada, we need 500,000 people to be working 24-hour shifts for the next 5 years to be able to meet the demand, the housing demand, the requirement, right? And obviously that is not possible. Those numbers just are way out of reach. With builders halting production, the reason why they're holding is because they oversold for such a higher price that they don't think it's gonna reach up there right now, right? But that is the main issue. I feel like that's why the builders are holding back, without finishing, because as longer they delay, the more chances of them reaching that price point and actually closing on a deal. Because at the end of the day, if somebody bought a $950,000 condo, 2 bedrooms, no parking in Mississauga on 21st, 31st, whatever floor, or over $1 million somewhere in Toronto, like $1.5 million, 1+1 band in Yorkville. You just not you can go and right now buy something cheaper. This is exactly the same, right? So I guess you need to hold production a little bit to make sure that the prices in the future will catch up, because people just won't close on them. People just walk away from the contracts.
So we got a lot of things changing, and you know what? The whole idea is to stay educated, to connect with people who are doing it, so you're getting the right information coming to you. We're coming to the end of our hour, and this has been wonderful. And Mark, could you tell people how to get in contact with you?
Yeah, the best way to contact me is just to call me, 416-305-1555. Or check us out on our website, any kind of Instagram or Facebook. It's dreamkeymortgage.ca. dreamkeymortgage.ca.
And for those who want, there will be the link posted on this video afterwards. So thank you so very much for coming on today and helping our viewers to become more educated, to become more aware of what to look for, and just to know when you're going forward, having that confidence that you are having people that are around you that know what they're doing.
Absolutely. That's the most important part. Glenda, Ari, thank you for having me. Have a wonderful afternoon. Bye-bye.
Thank you so
You as well.
much. Be well, everybody. And remember, it's time to become educated.
That's right.